Welcome back to Intermediate Macroeconomics. This is the first video for Chapter 2. And in Chapter 2, we sort of do a review of how to calculate our main variables that we talked about in Chapter 1, which is going to be GDP and GDP growth, the unemployment rate, and inflation. So let's get started. So we're going to start with GDP, right? And what we need to do is we need to define what we mean by GDP specifically. We'll see that there are actually three ways to calculate GDP. Then we'll talk about, in later videos, unemployment and inflation. We'll do some numerical examples to help you feel comfortable. And then we'll end first with a discussion of how the first 13 chapters of the book are organized. So the first part is about the short run, which is really about business cycles. The second part is about the medium run, which is how we get back from recessions and growth sort of to a more long run growth path. And then the third is the long run, which is really about economic growth. And, in the last chapter we said economic growth is really the most important thing. It's what allows us to produce more stuff with fewer inputs. And so we'll talk about that I think it's chapters 11 through 13 or 10 through 13. So what are we measuring in macroeconomics? Well, we didn't really measure much of anything in macroeconomics until the Great Depression. And in the Great Depression and then World War II, we said, we really need a measure of national income and product accounts. And so that's when these came about. And so what you'll see a lot is that our good data starts in usually post-World War II, sometimes in the 1930s. And then data before that has often been reconstructed by economic historians, but should be taken with somewhat of a grain of salt. So we're going to start here measuring aggregate output, or gross domestic product. Gross domestic product, usually referred to as GDP, is a measure of the value of everything we produce in an economy. So we have to define sort of what the economy is in a certain time period, and it's almost always a year. So let's think about how we might do that. So here we have two companies, right? We have a steel company, we have a car company. They both have revenue, right? So $100 for the steel company, $200 for the car company. They both have expenses as well. So the steel company has to pay wages, the car company has to buy the steel and pay wages, and then they both have a profit. So what is GDP? Well, should we just add up the revenue? Well, if we add up the revenue, then we're really counting the value of the steel twice, because we're counting it when the steel company sells it to the car company, and then we're counting it again when the car company sells it to the final consumer. And so we don't want to do that. So steel here is an intermediate good, whereas the cars are a final good. And so what this tells us is that really what we want to do is we want to count revenues from the final sales of goods and services, right? So things that are not going to be used to make something else. But that's not the only way to do it, as we will see. So our first way of calculating GDP is exactly that. GDP is the value of final goods and services produced in the economy during a given year. So in our example, in the steel company and car company, we just ignore the steel company. We take the car company's revenues. Revenues from sales are $200, right? That is GDP here. And you can see this because if we merged the two companies, right? If the two companies became one company, then they would have $200 of revenue. Their expenses would be $150 and their profit would be $50. So now, one thing to notice here is that their expenses and profit add up to their revenue, right? That's just the definition of profit. Profit equals revenue minus costs. And those costs look a lot like income because, in fact, they are income. It's income to the workers in terms of wages and income to the company owners in terms of profit. And that is actually another way to calculate GDP. The second way that we're going to calculate GDP is the sum of value added. So what do we mean by value added? Well, we start with revenue, right? And then we subtract off all of the intermediate goods. So the value added by a firm is the value of its production, that's its revenue, minus the value of the intermediate goods used in production. So how much value did the firm contribute to what it sold, right? So for example, if you're making t-shirts and you buy blank t-shirts from a company, and then you maybe silk screen them on and then you sell them, the value that you're adding is that silk screening process, but you didn't make the t-shirts, right? So that's not your value added. We're going to count that value added in the t-shirt company. Your value added gets counted as the difference between what you sell it for and what you paid for the blank t-shirt. So that is another way of looking at GDP from the production side. But as we said, we can also look at GDP as the sum of all income. Now, in fact, this is usually called GDI, gross domestic income. Theoretically, gross domestic income and gross domestic product are equal. When we add up GDP and we add up GDI, they're almost equal in a $20 trillion economy. So that's not too surprising that there's a little bit of difference. From our example, right, we've got labor income and we've got capital income or profit. And so our labor income between the two companies was $150. So that's going to the workers. And then our capital income or profit was $50. That's going to the firm owners. 150 plus 50 is 200. That's the same as the GDP calculated either method before. So we've got three ways to calculate GDP: sales of all final goods and services, value added across all firms, and income. So we talked about wage and capital income. We can also have rental income and interest income. Those are usually the four main income groups. Now, one of the things that we have to do is think about what happens when price changes, because GDP is going to be price times quantity for all goods and services, right? Added up, all final goods and services. But nominal GDP can go up either because we produce more, so the quantities go up, or because the prices go up. And we don't really like that. Really what we want to measure is an increase in GDP only if the quantities go up. So most of the time, we're going to look at real GDP. Real GDP is quantity times price, but not current prices, right? Not prices in that year, but some fixed price. And so, theoretically, this is pretty easy to do. You just choose a base year, you stick with that price. In actuality, it can get pretty complicated with the introduction of new goods, of higher quality goods. And so we have to take adjustments for that, and that can be complicated as well. So in the next video, we're going to do a numerical example of GDP, and then we'll get into unemployment and inflation.